Stick around because by the end of this video, you'll have a clear, actionable framework to start applying this method, moving from confusion to clarity. That's a common misconception that leads to a lot of frustration. And simply aligning your trades with that direction for as long as it remains intact. In trading, the trend is the current. Our job is to identify it and ride it. Price often pulls back towards a key area of support, a moving average, or a previous breakout level before it resumes its upward journey. They act as dynamic zones of support and resistance. But finding a pullback to a moving average isn't enough. You need confirmation. You want to see the market signal that the pullback is likely over and the main trend is ready to resume. This confirmation can come from a candlestick pattern, for example in an uptrend, after price pulls back to the 50 EMA. You might wait for a strong bullish candle like a bullish engulfing pattern or a hammer 2 form. This tells you that buyers are stepping back in and overpowering the sellers. This is your trigger to enter the trade. Next, and this is non-negotiable, is your stop loss. Your stop loss is your safety net. It's the point at which your trade idea is proven wrong. Where do you place it? In an uptrend, the logical place for your stop loss is just below the most recent higher low. Why? Because if the price breaks below that level, the uptrend structure of higher lows is broken, and your reason for being in the trade is no longer valid. In a downtrend, it goes just above the most recent lower high. Another powerful method is trailing your stop loss. Might even have more losing trades than winning trades. This strategy is especially effective for swing trading and position trading, where you hold trades for several days or even weeks. Now, let's talk about realistic expectations. A well-executed trend-following strategy will typically have a win rate between 35 and 50%.